The Warren Buffett Way is a book that reveals the investment principles of one of the greatest financial minds of our time. Warren Buffett, starting with a small amount, managed to build an empire and become one of the richest people in the world, while remaining humble, rational, and consistent. The book explains his unique approach to investing, the importance of long-term thinking, the ability to choose the right companies, and the discipline to avoid emotional decisions. The main idea is that anyone can achieve financial success if they follow fundamental investment principles, practice discipline, and manage capital wisely. Warren Buffett's journey to wealth began in early childhood, when he sold chewing gum, newspapers, and Coca-Cola bottles. Even then, he understood the power of money and compound interest. At the age of 11, he purchased his first 3 shares of City Service for $38. But soon, fearing a price drop, sold them for $40, earning only $2. However, the stock later rose to $200, teaching Buffett his first lesson in patience. He realized that true success comes not from quick decisions, but from long-term holding of quality assets. Later, he delved into investment studies and, at 19, read The Intelligent Investor by Benjamin Graham, which permanently changed his thinking. Graham developed the concept of value investing. An investor should buy stocks that trade below their real value based on fundamental analysis. Buffett adopted this approach as the foundation of his strategy, but with one crucial refinement. He not only sought undervalued companies, but preferred businesses with strong competitive advantages that could grow and generate stable profits for decades. This is how he began building his empire, investing in businesses he understood, and ignoring short-term market fluctuations. One of Buffett's first major successes came in 1964, when he acquired a controlling stake in the textile company Berkshire Hathaway, later transforming it into a powerful investment firm. Instead of staying in the unprofitable textile industry, he used its capital to buy profitable assets, including insurance companies that provided a steady cash flow for further investments. Fundamental analysis, patience, and a rational approach allowed Buffett to find companies with economic moats, competitive advantages that protect them from rivals. One of his most successful investments was in the Coca-Cola Company. In 1988, he acquired a large stake in the company, relying not only on financial indicators, but also on his understanding of the brand, consumer loyalty, and the company's global expansion. Coca-Cola had a strong market position, making it resilient to economic downturns and shifts in consumer preferences. Buffett applied the same principle to other investments. For example, in the 1960s, he invested in American Express after the company faced a confidence crisis due to a fraud scandal involving fake warehouse receipts. Most investors panicked and sold their shares, but Buffett saw that the company's core business remained strong and invested a significant amount. A few years later, American Express stock multiplied in value, proving his principle: buy when others are afraid and hold quality assets for the long term. He also preferred investing in companies with predictable business models, avoiding complex technologies he didn't understand. For example, despite the internet boom in the 1990s, he did not invest in dot-com companies because he couldn't determine their true value. As a result, he avoided the dot-com crash in 2000, when thousands of investors lost billions. His approach to risk was simple. The most important rule of investing is not to lose money. The second rule is not to forget the first rule. He never speculated or invested in stocks without thorough analysis. Another key point in the book is Buffett's attitude toward spending and lifestyle. Despite having a fortune of tens of billions of dollars, he still lives in the same house he bought in 1958 for $31,500, drives an inexpensive car, and eats breakfast at McDonald's. This is not just a habit but a conscious choice. He believes that money should work, not be wasted on unnecessary things. His philosophy is that wealth is built through smart financial decisions, not by displaying luxury. He avoids debt, preferring to grow capital rather than squander it. His longtime partner, Charlie Munger, once said, "The best way to get rich is to live slightly below your means and let your capital grow." Buffett always invested in himself, education, knowledge, and skill development. He stated that the most valuable asset is one's own mind. That's why he constantly read books, studied business models, and analyzed successful strategies of other investors. The book also highlights his approach to time management. He avoids unnecessary meetings, stays off social media, and focuses only on important matters. This principle helped him concentrate on what truly matters and make decisions that bring long-term benefits. He also avoids emotional decisions, which sets him apart from most investors. When the market crashes, he sees opportunities, not threats. His investment philosophy has proven effective for decades, and even in crisis periods. His company, Berkshire Hathaway, remains one of the most reliable investment vehicles. One of Buffett's most powerful yet underrated strategies is his ability to wait for the perfect opportunity rather than constantly seeking new investments. He refers to this as waiting for the fat pitch, a baseball analogy that means only swinging at the best opportunities. Unlike many investors who feel pressured to always be active, Buffett often holds large amounts of cash until he finds an extraordinary deal. This patience allowed him to make legendary investments during financial crises when asset prices were at historic lows. During the 2008 financial crisis, when banks and major corporations faced bankruptcy, Buffett invested billions in companies like Goldman Sachs and Bank of America, negotiating highly favorable terms that guaranteed him strong returns. While others panicked, he capitalized on fear and uncertainty, reinforcing his belief that the best time to buy is when the market is in chaos. This method of selective strategic investing contrasts sharply with the impulsive buying and selling seen in traditional traders and hedge funds. Another unique Buffett principle emphasized in the book is his focus on leadership and company culture when choosing investments. He does not just evaluate financial statements. He carefully studies the executives running a business. Buffett avoids companies with weak leadership, preferring firms led by visionary, ethical, and competent managers who reinvest profits wisely. He is famous for saying, "When a good manager meets a bad business, it's usually the business that remains bad." One of his most remarkable long-term investments, See's Candies, was largely based on his confidence in the company's leadership and brand reputation. Though it was a small company compared to his other holdings, See's Candies became one of Berkshire Hathaway's most profitable businesses, demonstrating that even non-tech, non-industrial companies could generate immense wealth when well managed. This further supports Buffett's belief that a strong business model, combined with great leadership, is the key to long-term financial success. The book also emphasizes that Buffett has always paid special attention to business ethics and trust. He believed that reputation takes years to build, but can be destroyed in seconds. So he always avoided companies involved in fraud or dubious schemes. For example, he refused to invest in Enron and other companies that manipulated their financial statements, despite their temporary market success. Buffett always chose businesses with strong leaders who focused on long-term growth rather than short-term gains. He was also known for his honesty and transparency with Berkshire Hathaway shareholders, sending them annual letters explaining his strategy, mistakes, and successes. This business approach made him not only a successful investor, but also a respected figure in the financial world. The book demonstrates that wealth is not just about money, but about principles that lead to success. Another crucial concept highlighted in The Warren Buffett Way is Buffett's aversion to diversification for the sake of it. Unlike many traditional investment strategies that advocate spreading capital across dozens of assets to reduce risk, Buffett takes a concentrated investment approach, believing that true risk comes from not knowing what you are doing, rather than from having a limited number of investments. He argues that excessive diversification can dilute returns and lead investors to own mediocre businesses rather than a few truly outstanding ones. Buffett's approach is often compared to placing large bets on a few exceptional horses rather than hedging across an entire racetrack. He believes that once an investor has thoroughly researched a company and found it to be fundamentally strong, there is little reason to seek safety in excessive diversification. He famously stated, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." This principle has shaped his portfolio strategy, where he often holds large stakes in a handful of businesses that he deeply understands and trusts. His investments in Apple, Coca-Cola, American Express, and Bank of America reflect this philosophy. Each of these companies constitutes a significant portion of Berkshire Hathaway's holdings because Buffett sees them as long-term, high-quality investments. The lesson from this is that investors should not diversify blindly, but instead focus on acquiring deep knowledge about a few businesses and investing heavily in the best ones. His success proves that having a well-researched, focused portfolio can often outperform a broad, diversified one over time. Thus, The Warren Buffett Way is not just a book about investing, but a guide to financial thinking. It teaches long-term planning, patience, wise capital management, and the importance of investing in oneself. Buffett's principles apply not only to finance but to life in general. Planning, rationality, and mindful decision-making help achieve success in any field. Buffett shows that wealth is not about quick money, but the result of a series of well-thought-out actions. Thank you for listening to this book review. If you enjoyed it, be sure to subscribe to the channel, share this video with your friends, and leave your comments. Let me know which books you'd like to see reviewed next. Your ideas and feedback are very important.